Markets are doing their thing, and we all get it tied up into the market's doing this or the market's doing that. When markets are doing very well, we kind of ignore risk. All it takes is some event to come up that kind of undermines that general thesis. Last year, AI was the thing and everything is great. And this year, it's all been this conversation about, well, will CapEx actually turn into revenue? And then you have this issue with Iran pop up, and that causes higher oil prices. That weighs on other areas of the markets. And this is when we talk about risk management so much. When markets are doing great, it's just easy to buy stuff that's going up, which is fine. But you've always got to be aware of these unexpected events that come along that cause potentially, and it hasn't happened so far, but something like a military operation in Iran could have upended the markets a whole lot more in theory. And if you kind of go back and look at previous wars over time, the general kind of decline in markets run 6 to 11%-ish when the war first starts. And then once you kind of get through that initial phase, the markets absorb that analysis, and then markets start to recover and move higher from there because war is good for economics. But we didn't have that happen this time. But that's when we was talking about managing risk, because you never know when you're going to wake up on a Monday morning and something's occurred over the weekend that undermines that whole kind of thesis that previously existed. Oh, markets are fine, earnings are fantastic. Something happens over the weekend, all of a sudden markets are repricing earnings expectations very rapidly to the downside, and then having to reprice markets because of that.
These narratives work both ways, and they're very easy to buy into. They, on the surface, make a lot of sense. For the large majority of investors, especially retail, that don't have experience, narratives are what's going to drive the themes. And there's all kinds of narratives out there. There's a Bloomberg article out there, Iran war oil shock threatens to unleash wave of global inflation. That narrative sounds logical. If we're going to be in a battle with Iran and oil is going to keep going higher, surely it's going to cause inflation. Oil is part of CPI, and if oil goes up, then CPI goes up. But it fails to capture certain things. When the price of oil goes up, we spend more on gasoline and heating our house. That means we have less to spend on other things. So yes, the price of gasoline may go up, and yes, it takes a bigger chunk of our wallet to pay for the gasoline, but we're going to save by buying less of something else. So there's a negative price impact on some other part of the economy, and there's also a growth impact that's costing companies more money to heat their buildings, to fuel their trucks, whatever it is. That's going to hurt profit margins. They're going to lay off people. Consumers won't spend as much, like we said. And yes, the narrative may be true that if oil stays high for a while, not a week or two, then yes, the economy may suffer, and yes, inflation may rise. Keep in mind, the Fed's not looking at this and saying, okay, gas is up 10-15% over the last week or so. We're going to have to raise rates because this is very inflationary.
Catch me daily on The Real Investment Show. The link is in the description.